A conventional loan is a mortgage that is financed through banks, credit unions, and mortgage brokers. These loans typically follow guidelines provided by government agencies such as Freddie Mac and Fannie Mae. However, each lender is going to have their own criteria in order to allow that financing. So you want to speak to your mortgage lender when it comes to that particular criteria. With a conventional loan, if you're putting 20% down, you avoid the extra cost of private mortgage insurance. There are some programs that will allow you to finance less than 20% down, and you want to speak to your mortgage loan officer as to what those minimum down payment requirements are. By putting a lower down payment than 20%, you are paying additional costs of what's called private mortgage insurance, or PMI, which is included in your mortgage premium. This cost is something that will automatically fall off your mortgage at about 78% of your purchase price once you have that 22% equity in your home. You certainly can speak to your mortgage loan officer in regards to qualifications on how to remove that sooner than it automatically falling off. At your closing, you will also have additional documentation which shows exactly when that timeline will take place, and that can be around the 6 to 8 year mark on average. These loans are typically financed directly through a lender rather than backed by a government entity. So you're not seeing an overlay of financing through programs such as FHA and rural housing. These ones you deal directly with your financial institution in order to process those programs. And sometimes with your local institution, they're the ones funding that particular loan for you as well. The Federal Housing Administration, or FHA mortgage loan, is an option for financing for borrowers with a low down payment. Typically, this requires just 3.5% of a down payment towards your purchase price. Closing costs can be paid by the seller or could be gifted to you as well. Where this is a higher risk loan with a lower down payment requirement, this is a federally backed loan that protects the lender in the event of a loan default or having the property foreclosed upon. However, that does still affect your credit score and history if anything were to happen. So of course, if you are following a hardship, certainly reach out to your mortgage lender as they are willing to work with you in regards to assisting you and avoiding the foreclosure process or doing a short sale on your home.